Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to Smart Investing. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Let's talk about what we're going to talk about today to make you a smarter investor. First off, do stock dividends give better returns? We'll answer that question. Maybe you're wondering that. We'll give you the answers. How will this U.S. government shutdown affect you and the economy? I think we're in day 8 or 9. I'm not sure exactly how many days we're on, but we'll figure that out. And then also, too, public debt looks strong. But private debt, well, not so much. And we've talked about this private debt situation, so we'll go more detail for that to make you, again, a smart investor. And also to help you out, we have Chase Wilsey. We're going to talk about what companies here today.
Yeah, companies we're going to look at includes Verizon, Cal-Maine Foods. This is an egg producer, and I've seen them in the news, and I've heard of the company. We've never looked at them, so I'm very curious. We know how expensive eggs got. Is this a profitable business to be in? And then we'll also look at International Paper and an interesting deal with AMD, Advanced Micro Devices, that occurred this past week. Sent the stock up a ton. So we'll look at the fundamentals on those companies, give you an idea if we think it's a buy, sell, or hold based off the numbers we see here on air.
And do we know what the cost of eggs? Are they down? Are they up?
I think they went up a lot, and then they've kind of cooled off a little bit.
Yeah, because that makes a big difference when you look at that egg company.
Yeah.
I don't have broken yolk all over the place.
Yeah.
So, but before we go talk about the companies, not the companies, but the topics here, we do want to mention that this is our last show on the Fan 97.3. If you want to find out more how to listen to the show will continue on. Go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com, how you can listen to the Smart Investing Show still. And but again, last show on the Fan. We want to thank them for being with us for 5 years.
Yeah, no, it's been a pleasure. And but again, as you said, the most important thing, the show will go on.
I've been at the Smart Investing Show. I think we're going on, 30-some years. Pretty much on a weekly basis I've done the Smart Investing Show. Before you were born.
Yeah, so I'm 32 now, so it's got to almost be 35 years.
I wonder if it's one of the longer running investment shows. That's a long time.
That is a long time.
I think my first show was in 1993.
That's the year I was born, so yeah.
No, I think it's before that then. All right. Well, let's move on. Do stock dividends give you better returns? With the S&P 500 currently paying a dividend yield of only 1.1%, which is the lowest in about 25 years, people may wonder if they should even care about dividends. In 2024, dividends were only 36% of the profits you were making, which was 20 points below the average going back nearly 100 years.
The interesting thing here is it seems like a lot more companies have been doing buybacks.
Yeah.
Which, of course, that's why you're getting such a big divergence between, a 36 and a 56% use of profits to pay out dividends. If more is going towards buybacks, well, it's going to distort that number. But the thing that always worries me about buybacks is, NVIDIA, Apple, I think even Amazon and Meta, I think they're all doing buybacks now. Well, that could be a complete waste of capital. The dividend, at least we've talked about this before on the show, the dividend is something that you get and cannot be taken away from you. The buybacks, if you're buying back stock at, let's say, $200 a share and it falls to $100, well, that doesn't help you, the shareholder.
No, not at
that
all.
would screw you over. So that is one thing I am a little bit maybe concerned about, is if too much money is going to buybacks and maybe not enough to dividends. Especially when you look at return figures. If you go back 65 years, reinvested dividends did account for roughly, I was blown away by this, 85% of the S&P 500's total return. And with the market at all-time high valuations, investors should not give up on investing in companies that pay good dividends. But they also should do plenty of research to verify the dividend is strong and will last, and never, ever buy a company just because it pays a dividend. It could be a terrible approach, because let's say you're getting great yield. All of a sudden, a year later, they cut it in half.
Yeah.
Well, do you hold the stock still? Because you bought it for the dividend. That's not the reason to buy the stock. The reason to buy the stock is it's a good business with strong valuations, and that dividend, as we always say, is like icing on the cake.
And again, people dividends are important, but you've got to understand how they're paying those dividends, because you can't just chase the dividend. We've seen so many companies over the years during COVID. How many companies? I think it was a third, maybe even a half, cut their dividends. Oh shoot! Now what do I do? So you got to make sure, again, do the research. And when looking for companies that pay dividends, this is what you got to do: look for stocks with new or increasing dividends, because since 1973, they returned an average of 10.2% versus only 6.8% for those companies that did not increase their dividend. And I love this one too. Over the same time frame, those stocks that did not pay dividends at all, their return over that time frame was only 4.3%. So that's a big difference. Dividends do account, as you said, since 36. When was that number you gave?
65 years
65 years. I mean, the dividends are so important. And people say, it's only 2-3%. What's the big deal? Well,
yeah, no, I mean, it adds up. And the big reason it adds up, too, we always talk about this, is those increasing dividends. I mean, they really are a game changer. I mean, I always talk about like a 10-year yield, right? If you're getting a 10-year treasury bond, it's right now around, I'll say 4% to make it easy on myself. That's all you're getting. You're getting 4% for 10 years. But a stock, a company, I'm going to make it easy on myself again. Let's say they pay a 3% dividend yield, and you're getting a lesser yield in the beginning, but after 10 years, they continue to increase that dividend. We've had stocks that, we bought 10, 12 years ago. The yield that we're getting now based off the initial cost basis is 11, 12, 13% because of the amount they increase those dividends. That is one of the beautiful things that people don't discuss a lot when you're discussing dividends, is those increasing rates really increase the long-term yields. But you have to remember to always look at the company to make sure it has good cash flow. Make sure it has a reasonable payout ratio so that dividend is secure. I mean, and you're looking at the payout ratio. I like to look at a few different things. What is their payout ratio on earnings? What about cash flow and also free cash flow? Because all of those things could be somewhat distorted by different accounting measures throughout time. So you might want to just check those three ratios. And then, of course, a strong balance sheet is imperative. You want to make sure they don't have excessive debt and a good amount of cash for liquidity. That is what will provide a stable dividend in the long run,
and
if
Chase,
not increasing.
Right. And we give you these numbers. And what I hope you get from this, it's so important that if you're going to try to do this yourself, you do the research. Or if you have a financial advisor, or I hope you don't have a broker who just sells you stuff, but if you do, make sure they're doing this research, because if they're not, they're just poking in the dark. They don't know what's going to happen next. You've got to look at the cash flow. You got to look at the payout ratio, the free cash flow. I mean, we love companies when we see increasing cash flow of the companies over the years. We know they're probably going to be increasing those dividends. So and people say, well, why do you spend 15, 20 hours looking at a company, and why do you take you weeks? Why don't you just do it right away? Because you've got to understand the business. You've got to look at these financial statements to really understand, so you don't get burnt down the road. So, should we talk about the government shutdown? Let's talk about it.
I know we talked about it a little bit last week, but obviously it is a new week and a new week and no new news.
Yeah, and I think well, Saturday it's 9 days. I think I started on Wednesday, so I think about 9 days.
Sounds about right.
Sounds right. So, but how will the U.S. government shutdown affect you and the economy? Now, think about this: over the last 50 years, the government has shut down 21 times. This is nothing new. 21 times, the longest being December 2018, when it lasted 34 days. The shutdown will affect mostly those consumers who are traveling, with experts from the travel industry saying it will lose, I love this number, it's unbelievable, about $1 billion a week because of the government shutdown. Now, think about all the national parks that will be closed and the frustrations at the airports. This is probably going to curtail a lot of travelers' enthusiasm for traveling. So I don't think, I don't want to travel now, do you?
Well, I mean, we talked about this a little bit last week, and we pulled in Harrison because he's traveling. Actually, today's Friday, so he's traveling
right
now, and I'm curious to see when he gets back from his trip how it was, because the thing you look at is people at the TSA. I think they still got their most recent paycheck, but I think next week is when they would start to not get a paycheck, and that's when the problems could ensue.
Then the reality sets in, and they know they're not going to get paid. They will get paid eventually.
So I hope for Harrison's sake that he was safe during his travels and he didn't have any slowdowns.
Right. Well, and I'm worried about him coming back. What if he can't make it back?
That's a good point.
Yeah. Well, Harrison, I'm sorry, you can't go. You're not leaving on vacation. Sorry. We got a nice beach here in San Diego.
So, yeah, but I wouldn't want to be flying at this time, as you said. But one thing that you look at from the stock market perspective, even with all the negative headlines, stocks actually tend to do pretty well during a government shutdown, with an average 3-month return after the shutdown at 9.5% and 1 year later at 22.4%. And to bring this up, not necessarily to encourage you to think that you'll get a 22% return this time around because the valuations on the stock market these days are so crazy, but just to show you that it doesn't really have an impact on the stock market. That is the reason that we provide these numbers, not to say, again, you're going to get 9.5% after 3 months and 22% after a year. But again, it doesn't really move the needle because many times the stock market looks through it. They know that maybe it's a month, maybe even it's 2 months. It's going to get resolved at some point.
Right. And we have to realize, too, that the market is very richly valued right now. Actually, on Friday, we did see because, oh my gosh, the tariffs came up again. I think President Trump said that, we're going to put 100% tariffs on China. Gosh, I think the NASDAQ was down 3.5%, Dow down about 2.7%. I mean, things are just like, and again, we've gone through this, but they still panic about it. And that's what you got to look at. But look at not just these numbers, but it should give you some good feelings here. But unfortunately, bonds, I was surprised with this, don't do as well with a 3-month return being a negative 37% and a 1-year return on bonds being a 10.7%, a minus 10.7%, not positive. What this means is during a government shutdown is generally long-term interest rates increase as bonds fall. And this would be a detriment to the housing market because why? You want a lower mortgage payment. Well, housing market, they're going to have problems because what will happen is that if bonds fall, rates go up, mortgages go up. So that's going to hurt the mortgage market and it's going to hurt the housing market as well.
Yeah, and I think the hard thing is, right, 21 times over the last 50 years is a lot. Yeah. But also in each one of those 21 times, there was other factors that were going on. So it kind of drives me crazy when I see a lot of these statistics that say like, oh, well, when the market's been up, 9 months into the year, then the last 3 months is up on average 10%, let's say. And those aren't exact numbers, but I think they're actually somewhere around there. And it's like, well, I mean, how many times has that happened? And then the variability on that data could be quite large. But if you have like 1 year, let's say, where it was up 20% over the last 3 months, and then 1 year where it was down like 2%, and then you had 1 year in the middle, well, it's going to average out to a nice strong number. I mean, 21 times, again, sounds like a lot, but you have to understand there's so many other factors that could have been at play during that time period that would have caused these numbers to respond a little bit differently. And I bring that up just because, we saw mortgage rates and treasuries actually fall on Friday quite substantially because of the news with China. Yep. We could be in the middle of the shutdown. There could be more news that comes out where this time it is different. So again, don't think that necessarily the numbers we're providing is going to be an exact playbook for what to expect over the next 3 months to a year. And one other thing that I think is the most crucial during this shutdown from an investment standpoint is the shorter end of the yield curve. Because right now the Federal Reserve, who sets short-term rates, they're going to be handicapped because they will not be getting economic information such as a labor report and other government data to make their decision for interest rate cuts. It is possible if the shutdown is still ongoing at the end of October, the Federal Reserve may not cut interest rates because of the lack of data. I've heard an argument on the other side, well, they don't really know, so they might cut interest rates because they don't have the data. So we'll have to see. The nice thing I did see today is the fact that the CPI will still be released. It won't be released on schedule, but they're actually bringing back people to make sure that is completed before the end of October.
Well, how can they do that if the government shut down? Well, we're going to bring back a couple of people just.
I don't know, and especially we're not getting the jobs numbers, which I think are equally as important for the Fed's dual mandate. So I'm like, why wouldn't you bring back people to do the jobs report and the CPI? But I saw the headline news on that, and it said this is new news, so more will be coming. Right. But it looks like that there will be a CPI report before the end of this month.
That surprises me, I will say. But the million-dollar question is, how long will it last? Is a difficult one to answer. And to be frank, no one knows for sure how long it's going to last. But it appears right now, since both sides are so far apart, they will not come to the negotiating table until some negativity starts showing up in the economy. That's what they're waiting for because right now there's no pressure. There's no pressure on the politicians, so they can be as hard as they want to. But as things start falling apart, like, okay, we're getting complaints from our constituents, we gotta do something here. But that does mean this shutdown could be one for the record books, which does not surprise me, and could perhaps last a month. I hate to say this number, but perhaps 2 months. We could see the longest one yet.
I mean, you think so? I mean, because 34 days was the record, right? So if we're at 34 days being the record, I mean, that would be a long time overdue. I mean, that'd be 60 days.
And that does put us into the holiday season as well, which is not very good.
I think we're going to get somewhere. If I just had to guess, I think we're going to get right around that 34-day mark. I think it is going to be a month because I just think, as you said, they're so far apart. I mean, and I hate politicians and the way they do things on both sides of the aisle. It's like, yeah, let's just keep voting. The Democrats propose their bill and the Republicans propose their bill. Oh, shocker. It's the same vote that we got yesterday. And it's just like, huh. And the other crazy thing is who's still getting paid during this is the politicians.
Right. And I would love to be a politician for like a year, not just to learn what goes on, to be in that chamber and see the craziness that's going on there, because we don't know what goes on behind closed doors. And it's got to be the craziest thing. And I do have a friend that's a congressman, but it's just like, he does say he gives me some stories.
I mean, it's got to be difficult, but, there's just so much infighting right now. And it just, as you said, it doesn't look close. So I would be surprised if we made any real progress within the next week or maybe even two.
And then it was funny, too, yesterday on Friday, where Trump came out and I guess threatened to increase tariffs on China to 100%. Market fell down dramatically because of that. So he's not worried about the government shutdown. He's still working on his tariff deal here.
Well, I think he doesn't have much control, right? It's going to have to be the Senate is really the sticking point. The House already approved the continuing resolution, so it's really just stuck in the Senate.
Right. But again, he's not softening up is my point. Yeah, I don't think he will. Let's talk about public debt. It does look strong, but private debt, well, doesn't look so good. Public debt, which are bonds that trade on the public market, is looking rather strong based on the small yield margin between investment grade and speculative grade securities compared with the risk-free government debt. That's what you really look at. Risk-free government debt, there's no risk on that. So you can compare other things to that risk-free debt.
And if you look in September, $207 billion of corporate bonds were issued, and that's the fifth highest monthly amount on record. Year-to-date returns for those holding public corporate bonds, well, that stands between 7 to 8%. So they've actually done decently well as, rates have pulled back a little bit.
But private debt, on the other hand, is starting to have issues as companies such as Tricolor Holdings, which is a lender to individuals with low credit ratings, filed for Chapter 7 bankruptcy in September. The debt holders, well, they may get something, but when a company files Chapter 7 bankruptcy, the government receives their money first, along with, no surprise here, the attorneys, and then, if there's anything left, then we'll give it to the debt holders, the bond holders, and then equity holders. So I doubt the bond holders will get anything here, or the debt, because they're not bonds when you have private equity, it's just debt.
Yeah, it's just you borrowed money. Yeah, you didn't own a bondholder. So I don't know. We'll see. And then also, too, when you look at last month, an auto parts company called First Brands, well, they filed for Chapter 11 bankruptcy as they had $6 billion of leveraged loans outstandings. I mean, we point this out because this could be the beginning of an avalanche of defaults in private credit. As I believe if the economy continues to slow down, these products will have some major problems. And the big thing we say here is hopefully you weren't sold anything that deals with private debt, equity, or real estate by your broker, because the concern is if there is an avalanche of declines, you won't be able to get out. You're stuck. You're trapped until they say you can get out. And the thing that you look at with this private credit is there are going to be a lot of different loans that were made. So, it wouldn't go to zero, but that 8% yield that you thought was promised because it was a loan and it was safe, and obviously they didn't say it was guaranteed, but maybe you were sold that it was safe. That is not maybe going to come to fruition if you're starting to see these companies file bankruptcy, because now they're not paying. Now they're not getting their principal back either. That's the big concern. If that happens, there's no principal left to be repaid. That's where these could really run into issues. Not to mention, we talked about in private credit, a lot of times the way that they're getting higher yields is through leverage.
Right. And I do want to mention also, too, I watch CNBC in the morning, see what's going on around the world. And yesterday morning, Friday, they were talking about, and I forget the name of I think it was private debt, but they were down, I think it was like 20%. So they mentioned another company that's having trouble with private debt. I think, again, we talked about, I think this tip of the iceberg, especially if we do see a slowdown in the economy, which we think we'll see, these are going to start having problems. Not just private debt, private equity, and private real estate as well. I think people are going to be very disappointed they tied their money into that.
When you kind of always look at it, again, if it sounds too good to be true, it probably is. With the 10-year yield around 4 and you're in a debt instrument paying 8, that's not risk-free.
No.
The risk-free rate is 4.
Right.
So you're doubling the risk-free rate. There is risk associated with that product.
I'm not sure if you can say that or not, but I kind of feel like, okay, if it's 4% is risk-free and you're getting 8%, are you doubling the risk? Probably not quite that easy to say that, but you are definitely having a much higher risk than that 4%.
Oh, absolutely. Yeah. And I was going to say the other thing too on the corporate bonds is it is interesting to kind of see the narrow spread, as you said, right now between treasuries and corporate bonds. And generally, I like to lean, I think, it's kind of funny. We don't buy bonds. We haven't bought bonds in so many years. It was about 2007. But ideally, I would look at a corporate bond because you get a little bit higher yield, especially in a tax-deferred vehicle. You're not paying the interest tax on that or the income tax on the interest. But now with the spread so tight between treasuries and corporate bonds, I mean, sometimes the treasuries might be better because especially here in our lovely state of California where we have such high tax rates, well, you're getting the treasury state tax free, where if you have a corporate bond, you're paying income tax in California on that bond. So, if you're looking at these different rates and stuff, and it is a narrow spread, if you make high income here in California, the treasury might be a better rate for you than a corporate bond.
All this information does come in our newsletter. It goes out every Friday at 5 o'clock by email. Sign up for it. Things you will see this Friday on the email, you should see on the email, would be including financial planning, updated tax brackets for 2026. Be kind of curious to see what those are. Why would any company set up manufacturing in the country of India? You'll see why. Clock is ticking on home energy tax credits. Are you being too cheap? I like that one. That was pretty good. For young people today, financial stability comes before marriage. Do you need a daily money manager? And could there be a nuclear reactor on the moon in 4 years? And this is all on that newsletter. It is free. Go to our website, smartinvesting2000.com, smartinvesting2000.com. I think you'll love the newsletter. We get a lot of people say, gosh, I love the topics you come up on that newsletter. Very easy to read. All right, should we dive into a company here before the break?
Yeah, let's do it.
Okay, let's talk about, I don't know if people know this company. It's called Verizon, symbol VZ. I love Verizon.
We use them. So.
I've been with Verizon, I think, since cell phones came out, like in '93, I think. So, but they're in the telecom services industry. Short on the float is only 2.2%. A lot of individuals hold this because institutional ownership is only 68%. Nice PE ratio, 9.4, well below the industry at 33. Price to sales, 1.3, about the same as the industry at 1.2. Price to book value, 1.7, better than the industry at 1.9. And price to cash flow is 4.6. That is more than the industry at 3.8. Now, they do have a PEG ratio of 5.5, which sounds high, but the industry has no PEG ratio at all. Now, over the last year, earnings per share, they climbed by 86.1%, when the industry is up 6.7. I've got to say, we know there's something else there that caused those high growth on the earnings per share. Sales were up 2.1%. The industry was down 2.3%. And the 5-year growth on the earnings per share estimate is 1.6%, but the industry is a negative 3.6. Now, they do pay a dividend. You got to love this yield. It's about 6.9%. They only use 63% of their earnings to pay out that dividend. So that means that dividend is probably pretty safe. You know, look at the free cash flow, some other things as well, how much cash on the balance sheet. But at 63%, that's probably the top. But shoot, you're getting what I say, a 6.9% dividend. That's not bad at all. Look at the balance sheet. Current ratio 0.6 versus 0.9. It's a little bit low. I would like to see it a little bit higher. Debt to equity is 1.7. That's the same as the industry, but we talk about leases. That does include leases in there, and we've kind of looked a little bit at that. The leases do account for a fair amount of that debt, so that's a positive thing there. We do see net profit margin, 13.3% for Verizon versus 8.2% for the industry. Return on equity is 17.7 versus 15.1, and you gotta love this number. We talked about dividends. The free cash flow for Verizon over the last year is $19.6 billion. That's more than 3 times the industry at $7.6 billion. So that looks pretty attractive. Jace, what do you got?
And I was going to say, we did look at the cash flow statement. I just kind of looked at it too. I mean, they've pretty consistently had around about $20 billion in free cash flow, it appears. So, I mean, it's again a stable business. You're not going to set the world on fire here and get amazing growth on the sales and the earnings. But shoot, with a 7% yield, if that is secure and not cut, I mean, you don't have to do very much on the price appreciation of the stock to make 8 to 10%. Yeah. But looking at the numbers here, I mean, Verizon right now, it's at $39.85. The 52-week range, the low here, $37.59, and the high, $47.36. So we've gotten a decent-sized pullback from that that 52-week high. And going forward, I mean, the valuation, it looks quite intriguing. You got to 2026, estimated earnings per share here, $4.84, gives you a target sell price at $80.34. I mean, you're getting a forward PE around 8.5 times. So, I mean, this business is definitely on sale, again, with a very strong dividend. I'm going to say pretty clean financials. Yeah. I mean, it looks intriguing. The interesting thing here as well is the CEO actually did step down, and they announced they're replacing him with a gentleman by the name of Dan Schulman, and he was the former CEO and president of PayPal from 2014 to 2023. It looks like during his time at PayPal, the company tripled its revenue, increased payment volume to $1.5 trillion, and grew to 435 million users. I don't know if I necessarily see the crossover between PayPal and Verizon, but, the very least, I can say he knows how to manage large user bases.
And I think he's a CEO that with PayPal, he started going more towards small businesses, working with businesses and stuff. So
that was the new CEO.
That's a new CEO.
Yeah, the new CEO came at PayPal, came from Intuit in the small business division.
But again, with PayPal, I know they work on businesses and stuff. I mean, and a lot of times a CEO, it's a little bit different job, but you don't have to have the same experience in that industry. Running a business involves understanding the marketing, the technology, all these different factors, how to run a business. And you may not know the business. You can learn the business concepts, but it's important to be a good manager of how to manage and motivate people.
I'd agree with that, but also there are cons to hiring somebody that doesn't understand the business. And Verizon, I'm not necessarily worried about that, but I think about Nike. Nike hired a tech guy to come in and run it, and he did not do a good job, I think, implementing product first, which really hurt the business in the long term. Mm-hmm. And kind of same thing, too, with tech companies. We have a finance guy. We've seen this before with Intel, where they had a tech guy running the business. No, I'm sorry, a finance guy running the business, and their technology, I think, really suffered. So I don't really see that as the case with Verizon and Dan Schulman. I think there is enough crossover there for him to have success in Verizon, but there's sometimes where a CEO might not fit the business the right way.
Another one, too, that happened to, I think, is Lululemon. Mm-hmm. I mean, the founder left. I think he's booted out. I think their stock is down like 60% since he's been gone. So, I mean, that's another one that the new guy coming in didn't fix it. But, and again, we're finance guys. I think finance guys are not the best as a whole to run a company because we are so concerned about the bottom line. Sometimes we can't see the vision, the future. We get too focused.
Especially when it comes to technology and style, brands.
Yeah. All right. Well, there's the music. We'll take a quick break here. When we come back, we'll talk about CalMaine, International Paper, and Advanced Micro Devices. Stay with us. You listen to Smart Investing with Brent and Chase. All righty. Welcome back to Smart Investing Show. And this is the portion where we talk about financial planning. For that, we're in Harrison Johnson. But before we get to you, Harrison, I do want to mention to the listeners of The Fan, 97.3, that this is our last show on The Fan. So if they like listening to your financial planning section, they've got to go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com, and how else you can listen to the Smart Investing Show, because it's been a great time with The Fan, but our time has come to an end. So this is our last show with The Fan. So let's talk about financial planning. For that, you're talking about, and I love this one. I mean, how do you get this information? Updated tax brackets for 2026.
So this is new. I think the IRS released it this week, but every year they come up with new numbers for, what the standard deduction is going to be, the different ranges that the tax brackets are in. So this week they came out with the updated rates for next year, 2026. So this is when you're going to be filing in then April of 2027. But you can use this to make, financial decisions as we go into the new year 2026. So the standard deduction, if you're a married couple filing jointly, that's increasing from $31,500 to $32,200. So an increase of $700. It's like an extra $700 deduction for you. If you are over the age of 65 filing jointly, you get an extra $1,650. That's up from $1,600 last year.
Now you always say I don't get this. Am I going to get that, or do I get bumped out of that too?
You itemize, so you. Oh, I won't go. This doesn't matter to you, but your itemized deduction is larger than that.
Okay.
This next part does not apply to you,
there
Brent. But so this was as of the tax bill that was passed a couple months ago. But if you're 65 or older and If your adjusted gross income is less than $150,000, you get an extra $6,000 deduction per spouse. So with this larger standard deduction, and then if you're over 65 and if your AGI is under 150, that means for tax year 2026, your standard deduction could be as high as $47,500. So what that means is the first $47,500 of income from any source is basically tax-free. And then once your income goes above that $47,500, then you start to go into the tax brackets, 10, 12, and kind of up from there. But that's a really large number, almost 50 grand, basically tax-free for a married couple.
You know, and I would not be surprised because across the country, if a lot of people don't itemize, because here in California, the houses, $1 million houses like the average now, with the deduction in interest rates that they had, so these people at 3%, 4%, they're probably not itemizing. So this is a nice gift for them. I think you said the number is 47,000.
47.5. Yeah,
47.5.
it's a lot, and most people haven't been itemizing. Now, another part of the tax bill that passed a couple months ago was the repeal of the $10,000 cap on state income and property taxes. So now people in California potentially will be able to use that to be able to itemize. But again, if you're over 65 and with these income amounts, 47.5 is a really, really large number to get under. Yeah. But in addition to that, so once your income goes above that, then you start to pay taxes. But the point I want to make is there's, I think, a really important threshold right around an adjusted gross income of 150 grand, because at that level, again, you get the extra $6,000 deduction for each spouse, so $12,000 total.
And that's for joint couple filing.
Joint. If you're single, it's exactly half that.
75. Okay.
75. But at an AGI of 150, if you subtract out the standard deduction, basically what that means is if your income is under that threshold, then all of your ordinary income basically falls in the lower tax brackets, the 10 and the 12% bracket, and all of your capital gain and dividend income falls in the 0% bracket. So an AGI of 150 is really important. You get all those deductions, your ordinary income is taxed at low rates, and your capital gain dividend income is tax-free. Once your income goes above 150, you start to lose that $6,000 deduction, starts to get phased out. Your ordinary income starts to go into the 22% tax bracket up from the 12%, and your capital gain and dividend income starts to go into the 15% bracket up from the 0%. So all three of those things happen right at an AGI about 150.
You know, it's so important. If you're on that cusp and your boss like, oh, you're going to get a raise. No, I don't want a raise. Give me more vacation. Give me something else.
Or put it into your 401k.
Put it in
that.
Okay, you can do that. Yeah. But if I'm assuming people are maxing out.
Give me the raise.
More. Yeah. With that, don't turn down income. More income is generally going to be better than less income in 99% of the cases. The only case where it's not is like if you trigger Irma, just barely. Right. But don't turn down a raise, because hopefully there's something else you can do. You can put it into your 401k. You can try to maybe give a little bit to charity or something. I don't know. There should be ways to hopefully mitigate that. But again, people need to keep that number in mind, because if you're withdrawing from retirement accounts, IRAs, that's taxable. If you're doing Roth conversions, that has an influence on it. If you realize some extra capital gains, that could push your AGI up. So, there's a lot of things to keep in mind as in tax planning when we're trying to structure and lay out how much income you should have.
And that's why we say you're a fee-based planner. Another reason why we always tell people to contact you before they do something. So if they say, hey, I think we get a raise, they need to contact you and say, should I take this raise? What should I do? And you can figure it out saying you're not adding to your 401k, increase that. Or if they are, all these different things they can do.
Yeah. So take the raise, and then this is how we can, mitigate it. Maybe you were putting money into a Roth account. We'll put more into your pre-tax account so we can stay under that threshold if that makes sense long-term, or, whatever it is. So, but yeah, a lot of times people make decisions without fully understanding all the consequences with that decision, and in many cases, it can't be undone. So I like to know ahead of time so it can help people that way. Jay's nothing to add?
Nothing really, yeah.
I felt I was kind of hogging the mic there. It's like Chase was sitting there.
You pretty much covered it. I was kind of doing a little research on eggs. I was kind of getting ahead of our next topic there, but, Yeah,
Well,
it all sounds good to me. No.
Yeah, well, it is good, and it's nice that you know. And again, this is why I always say a fee-based planner is the best, because you know this ahead of time. I'm certain that a lot of these guys that do financial planning and try to manage money, they don't even know 2026 yet. They don't know this stuff. They don't have time for it.
Well, I mean, a lot of advisors, I think, say that they keep an eye on taxes, or they do tax planning, or they do financial planning. But for most advisors, I think their idea of tax planning is putting money into a tax-deferred annuity or something like that, or
we know how much you love annuities.
Yeah.
We heard a couple weeks ago.
or put money into your 401k. Maybe that is the right thing to do. Maybe there's something else to do. Yeah. So this is what tax planning is about: is understanding these thresholds, the different levels of income that you have, the different types of income, how they're taxed, what brackets that you're hooding up against, and then what you can do about it. And then structuring that every single year and trying to keep those things level. That's really what tax planning is about.
Well, and understand too how the numbers work. I mean, because sometimes we've seen clients with large capital gains, and I firmly believe now where the markets are at, it is worthwhile to pay those capital gains, and it's going to hurt you maybe for a year, but knowing how that impacts your tax situation maybe next year versus the following 5-10 years, I think is so impactful, because it is a decision that might be like taking one step back to go 2 steps forward.
Yes, because, in this threshold, we're talking about keeping an AGI under 150. If you can feasibly do that, not everybody can do that for different reasons. Maybe you have a pension that fills up a lot of that, plus Social Security, plus RMDs, or whatever it is. So that might not be possible. And with the case of capital gains, once you go into that 15% bracket, that happens at a taxable income of now $98,900, so right around $100,000. That's where the 15% bracket starts, and then that goes up to taxable income of over 600. So it's a very large threshold. So some people might not want to sell and realize a capital gain because it's going to be taxed at 15%. That might be unavoidable no matter when you decide to sell. So it might be worth it to say, okay, yeah, that is worth selling. We know that it's going to be taxable, but we're never not going to pay that tax.
And I think that's a big thing people miss. It's not about tax planning in 1 year. It's about tax planning for the future.
Yeah,
the future years to come, not just one.
Great. Well, Harrison, as always, great information.
Thanks, guys.
All right. All right, then that is Harrison Johnson. He is a CFP with Wilsey Asset Management. If you want a free consultation with him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or you can contact him through the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Harrison Johnson. All right, you want to do another company?
Let's do it.
Let's do Cal-Maine. Now, Cal-Maine, I love their symbol, CALM, and that's just because of the letters. I thought, well, what's CALM about it? I mean, it's farm products, but they were in the industry of farm products. They do have some problems. They short on the float is 12.2%. That's pretty high. We do see 94% is institutional owned. This PE ratio, very strange. You'd have to look deeper at this because it looks very attractive, but that can be dangerous because the PE ratio, 3.6, very low. That means you get back your earnings that would pay for the stock in about 4 years. The PE for the industry, 14.9. Price of sales, 1.1 versus industry at 0.4. Price of book value, 1.7 versus 1.3. And price of cash flow is 3.3 versus 6.6. Another pretty good attractive number there as well. No PEG ratio for the company or the industry. We do see earnings of last year, up 197.9%. The industry is only up 42.5%. That's probably because of the high price of eggs they were getting before. The sales for the company were actually up 65.8% over last year. The industry was down 5.7%. So Cal-Maine has done a pretty good job here. Now, the 5-year growth rate looks terrible, says the analyst, a negative 142%. So they think the price of eggs will be falling, and Cal-Maine will not benefit from that. Here's another very good-looking number that could be dangerous. The dividend yield, 9.2%. We talked about dividends earlier in the show. They do have a payout ratio of 31.9%, but keep in mind, the payout ratio is on past earnings. If the earnings fall going forward, they could have to cut that dividend because they didn't earn as much as they were before. We do see here that the balance sheet, current ratio, wow, a lot of cash here, 6.8 versus 2.5. No debt on the balance sheet. I like seeing no debt in the balance sheet. Industry's at 0.7. We also see, a net profit margin, very good, 28.9. It kind of makes you a little bit frustrated because, hey, they were making a pretty big profit when the price of eggs were high. I guess they weren't scripting. Return on equity is a 47.1. That's a positive. We do see, let's see, free cash flow, $1.215 billion. That's exactly the same as the industry. Chase, what do you got going forward?
There's a current price here for Cal-Maine Foods. Again, their ticker symbol CALM, C-A-L-M. It's $94.43, 52-week range. The low here, $79.55, and the high, $126.40. And it looks like it hit that earlier in the year. And then actually it did rebound again, kind of back in July. It popped up nicely and since then had a substantial pullback, I would say. Going forward for the business, though, we go out to May 2027, you see estimated earnings per share here of just $6 per share. It gives you a target sale of $99.60. So forward PE is right around 15. But here's the interesting thing, and kind of to your point about the profit margin being high. Well, now things are changing. The earnings this year are estimated to fall 59%.
Oh, yeah.
In May 2027, they're estimated to fall another 41%. And you look at egg prices, I mean, they kind of are all over the map. Obviously, we had the issues with the avian flu. And one thing I hate about egg prices is there's so many different data points because there's, your white AA eggs, and then they have the different sizes. They have the different
brown eggs,
organic, the free range, all the different types of eggs. So I just have this one chart on this website called Trading Economics. But it looks like back in March, eggs did hit a record high. Gosh, it looks like they were above $7, and now they're back around $1.05 for a dozen eggs.
So eggs way back in price.
Way back.
Wow.
This is saying that we are now at egg prices, the lowest levels in nearly 2 years.
You don't hear about that.
You heard about it on the way up.
Oh, definitely. Like, eggs are this, eggs are that. No one tells you that eggs, because I didn't look at it before the show, but you said the average price for eggs is $1.05.
It looks like about $1.05 for a dozen eggs.
Yeah, and that does reflect. I have a little bit different numbers than you have because it shows 2026, the estimated earnings from only two analysts. That's a problem as well. $10.04, but May 27, cut in half, $5.67. So you get pretty excited about this, and this is why we say, don't just look at the surface numbers, because you've got to understand the numbers and dig deep to understand what's going on.
Well, here's something too that I was just thinking about. Well, number one, one of the reasons the stock pulled back was a subpoena from New York State asking for information tied to an investigation to anti-competitive practice and high prices. And you kind of talked about, I think jokingly, about the high profit margin and how they weren't skimping during that time.
Right.
But one thing you have to understand is accounting standards. And I don't know how the egg business works necessarily. But if they're on what's known as FIFO accounting, that means first in, first out. Right. If they got eggs, let's say, in October of last year, well, egg prices were around $1, looks like about $2.
Right.
So that is the inventory they were selling maybe when prices were at $6. So they were getting a huge margin because their sales were around $6 and their inventory of eggs that they were selling were maybe around $2. Well, now that flip is going to that script is going to flip, where now they might have been buying eggs when they were around $6, and now they have to sell them at a much lower rate. But because of the way the accounting works, it's called FIFO. First in, first out. That is how your cost of goods is calculated. If you got inventory at an inopportune time, that is going to compress your margins. If you got it at a great time, it's going to expand your margins. And I bet you this is something that the state of New York will not look at.
And I have seen companies, and I don't know what the requirements are, to change their inventory accounting, FIFO versus LIFO. So I don't know if they're doing that. I know energy companies, oil companies do that many times because oil sitting at a high price will change the inventory. How they do it. So,
but ultimately, I don't think Cal-Maine did anything wrong. I think it was just the market forces, and it kind of caused this strange period of time where profit margins were elevated. But now we know profits are going to decline quite substantially over the next couple of years. So I don't think there's anything wrong with what they did. It was just the way that the market forces were. And kind of tie this all back together, I would not be buying the stock at these levels.
No. And I've been wondering. I see my wife coming home with a lot of eggs lately. I didn't know it's only like $1.05.
Yeah, that's good.
That is very good.
Well, I mean, we talked about before. More and more people are getting chickens. That's more competition in the marketplace.
Yeah. Well, price of chicken should be down too then. And I don't hear about the avian flu anymore either.
Yeah, I'm not sure. I didn't get to look at the price of chickens.
Yeah. So it's a whole different thing there. But I guess. Cal-Maine is not worth a scrambled egg that you want.
No, I would not be buying here.
No. So let's talk about a paper company that's no longer a paper company. We're talking about IP, International Paper. Chase will talk more. I think you have some data on that one. It's not a paper company any longer. They too, though. Here's another one. I feel like we're stuck on the short here. 12.4% they said is a short on IP, again, international paper. 100% institutional owned. Here's a bad start. No PE ratio, which tells me over the last year, no earnings. Industry's at a PE ratio of 30.2. Price of sales, 0.9. That's the same as the industry. Price to book value, 3.6 versus 45.1. That is a positive. And price to cash flow, not good for international paper. It's 17.3 versus 9.7. They do have a very good PEG ratio, 0.2 versus 6.1. Now, no earnings over the last year, even over the last 5 years, shows no earnings growth. However, sales were up 17.7% of last year, not quite as good as the industry, up 25.8. And they do have, from the analysts, a 5-year estimated growth in their earnings of 93.7%. So things look like they could get much better going forward. Now, you do get a nice dividend. The dividend is 4.1%, but keep in mind they have no earnings, so there's no payout ratio. So they could be this is terrible, they could actually be borrowing money to pay that dividend. We don't like when that happens. Could be a dividend cut coming up as well. We do see on the balance sheet, current ratio 1.3 versus 1.7. That's okay. Debt to equity, not bad at all, 0.6, half the industry at 1.2. We see a net profit margin for international paper of a minus 0.1%, but the industry is a positive 4.2. Return on equity also negative 0.1%. Free cash flow, it's a negative $118 million. Industry positive $338 million. I was kind of hoping that we'd find something here. Maybe got something and change my mind, but I'm not impressed at all what we're seeing there, Chase.
Yeah, current price here for International Paper Company, ticker symbol is IP, is $45.69. And the 52-week range here, it has fallen. I mean, the low is $43.27 and the high $60.36. Year to date, the stock is down about 15%. And you're right, it is interesting. They're not really a paper company anymore. I wonder if they should change their name to International Box Company or something instead. They completed a spinoff actually back in 2021 of a company by the name of Silvamo Corporation. That was their global printing paper business. I did go online too to check International Paper. They actually do like paper bags and stuff like that too. So they still have some paper business, but
they don't
when you're
create the paper.
Or if you have like printer paper,
right.
They're not doing printer paper.
Okay.
They're doing other paper products and then box solutions, corrugated boxes, things of that nature.
Yep.
So, not necessarily, I think, what you would think of if you hear International Paper Company. I initially think of like the show The Office, like Dunder Mifflin. They're just selling the paper. Right. That's not what they're doing.
No.
But anyways, we look forward for International Paper. We go out here to December 2026. I see estimated earnings per share of $3.07. It gives us a target sell price of $50.96. Forward PE is around 15. But this is where it's interesting, and I'd have to understand more on the accounting of what's going on here. Another accounting oddity, I talk about with Cal-Maine, also International Paper, like this year earnings are estimated to grow 53%. 2026 are estimated to grow another 76%, while revenue is not estimated to grow that amount. This is kind of surprising, actually. 2025 revenue growth is estimated to grow about 39%, but next year just 2%. So a huge differential between earnings and sales growth. Don't know how that could be taking place. And back to your point about dividend safety, if those numbers come to fruition, where you're getting earnings growth of 53 and then 76% the following years, that dividend should be safe.
And I don't know if the tariffs have any bearing on international paper or not. I did notice what you said. 2025, the earnings are $1.74. They jumped to $3.07 2006. That's 12 analysts, but they're not very tight. The low estimate is $2.39. The high is $4.34. So I would not still recommend buying this dividend based on the future here. So it's just
even still the valuation doesn't make sense.
Yeah,
I mean, at 15 times earnings, not worth it. One interesting thing though is this continues to struggle. Even less analysts, but they're still looking for further growth in 2027. That would put you at around 12 times multiple. So I mean, who knows? I mean, maybe at the beginning of next year, if things struggle, maybe this could be worthwhile. But right now, I'd be patient, kind of sit, watch it. But like I said, not worth it at this price.
Yeah, and the risk is, I think, pretty high. Doesn't mean it won't come through, but again, people chasing dividends like, oh wow, this pays a 4.1% dividend. I think I'll jump in. You're jumping into a bag of snakes here. I could work out, but I would not. I'd put my money someplace else. So.
Yeah, I don't know if I'd go bag of snakes. I think this is not as risky as a lot of other things in the market, but I'm not giving my stamp of approval on that. I think you're right. There's a lot of other opportunities that are better.
Not as risky as a bag of snakes, you said?
But not as risky as a bag of snakes. I think there's a lot of other stocks that fit that criteria.
I just like that saying, so I want to throw it out. Well, let's talk about the next company is AMD, or Advanced Micro Devices, in the news recently. And gosh, your stock has been on fire this past week. They're in the semiconductor industry. Their symbol is AMD, which most people call them that. Short is only 2.6%. Surprise here. Institutional ownership is 69.1%. That means about 30.9% of individuals hold this stock, which is a surprise being a tech company. PE ratio, wow, what a deal here, 128.1. The whole industry is at 58.2. Wow, that's very, very expensive. Price to sales, 11.8 versus 13.8. Price to book value, 5.8 versus 11.8. We do see price to cash flow for AMD as 72. That's double the industry at 37.2. And the PEG ratio now does look good, I got to say, 1.3. The industry's at 12.1. Look at the earnings. They are up 47.8% over the past year. Industry did better, though, 56.3. And sales for Advanced Micro Devices were up 21.8%, about half the industry growth at 59.6. And you think about these, and it's just like, gosh, these growth rates cannot continue. But the analysts do say for the 5-year, they say the earnings will grow at 39.7%, industry at 42.2%. They do not pay a dividend. I thought they did, but they do not. Like, taking a look at the balance sheet, current ratio 2.5 versus 3.3. That's good. Debt, very good, 0.1 versus 0.3. We do see a net profit margin of 9.6 for AMD. That's about a third of the industry at 24.6. And then they do have a return on equity of only 4.8 versus 58.9 for the industry. That's not good. Free cash flow, oh, this is very disappointing. It's a $4 billion, which is a good number. But the industry has a free cash flow of $43 billion. So AMD is about 1/10 of that free cash flow. So that's not good there. What do you got going forward, Chase?
There's a current price here for AMD, $214.90, 52-week range. I mean, wow, the low $76.48. The high, though, $240.10. And this stock did pop this week to that high, and subsequently has pulled back from the hype, I would say. Again, I think the high was 240, now back at 214. But what happened was, in the excitement, the chip maker actually surged about almost 30% following a deal reached by OpenAI and AMD that could see the ChatGPT parent take a 10% stake in AMD. I think there's also some contract news with that too. It's not just like, oh, I think AMD could be potentially selling chips to OpenAI, which is the excitement around that deal. Not obviously that OpenAI will take a 10% stake. That shouldn't have any bearing on the stock. But again, that potential to be selling chips to OpenAI is, I think, why people got excited about it. Going forward, though, I mean, it's expensive. I mean, there's a lot of hype, obviously, in this space. I mean, you talk about NVIDIA, you talk about AMD. I mean, this company in particular got to 2026 estimated earnings per share, $6.19. Gives you a target sell price of $102.75. Forward PE, over 37 times. And, you know, the interesting thing here, you talked about the wide range on the last company we looked at. This one, the low here, $4.92. The high, $10.
Oh, wow.
Huge range. And the thing that I'm not understanding about this, right, is it made me laugh, just kind of showed how crazy I think the stock market is right now. After this deal was announced, obviously AMD was up a ton.
Right.
But NVIDIA also went up a decent amount.
Why?
And the thing that's interesting, and a lot of people, oh, finally a formidable competitor to NVIDIA. Why would NVIDIA go if AMD is going to be able to maybe take some of the market share? Because if AMD creates, let's say, a more formidable competitor to NVIDIA's chips that OpenAI is using, you think OpenAI is going to be the only company using the chips? There'd be other companies that would use it too, and that should steal market share from NVIDIA. But again, that's doesn't mean I'm saying, yeah, go buy AMD. I still think there's just so many question marks around this space that even silly little headlines like that can move the market for these companies in dramatic fashions. But I mean, you've seen kind of Oracle as another example. That thing went up a ton. That's pulled back quite a bit as well. There's a lot of noise and a lot of volatility in these stocks. And right now, I think they have become more gambling chips with people getting too futuristic in their expectations.
And I think that's what people have to realize is that, you know, you see these jump dramatically. They could just be buying one share and it would show that price. So you don't be sucked into this now. And I do have, you didn't mention it, but the 5-year and the 10-year return. They've got, I got to say, the 10-year return. Congratulations if you bought and held this for 10 years because your return is 11,000%. But the 5-year return, 148%. So that means It took a major up and then a major down again. Very volatile these stocks are. And I doubt very few people held this stock for 10 years. I mean, I think if you found one, that's pretty successful because you had a major drop to get a 5-year return of 148%.
Yeah. I mean, it's a crazy.
Got time to take a look at the chart, see what it did, or no?
Yeah, I would just say it's just kind of crazy. I mean, you kind of see the chart; it goes up and down, up and down. I mean, as I said, the low was 76 and the high's 240. I mean, you're seeing this type of volatility. It's all over the place, so it's risky.
All right, well, this is Closing Battle. Thank you for listening to the Smart Investing Show. I do want to mention and say thank you to the fan for having us on air for 5 years. This is our last show with the fan. So, again, thank you very much for letting us be on your airwaves there. Thank you to listen to the Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004, or go to the website smartinvesting2000.com. Again, that's smartinvesting2000.com. Thanks for listening. We'll be back next week.